Okay, well, let's get going. Welcome everyone to our fourth quarter macro and markets quarterly update. My name is Kevin DeSano, Chief Growth Officer here at Beacon Pointe. Joined today by Michael Dow, our Chief Investment Officer. We're very excited to have you all with us today. And before we get started, I just want to go through a couple of housekeeping items. We will be taking questions throughout the course of the webinar today. So if you have questions, right at the bottom of your screen there, you can see the little Q&A chat box. Click on that, send your questions in, we'll compile them. We probably won't have time to get to all the questions, but we'll certainly select from the bank of questions that come in and pose those to Michael during the call today. In terms of recognizing our veterans, happy Veterans Day. Here at Beacon Pointe, veterans are a very important part of everything that we do. In fact, one of the co-founders of our firm, Garth Flint, is a veteran. We have a number of advisors on staff that are veterans. You see a collage of photos of our veterans here on the slide. My father spent 24 years in the United States Air Force, so I have a special place in my heart for veterans. So just a big thank you to all the veterans out there who have served and are serving our country today. The next slide is our agenda. So on our agenda today, we're going to be talking about inflation. Is it persistent or transitory? The second section will be about equity markets. Where are we going and where have we been? Third up, we'll talk about what's going on in Washington, D.C. And then finally, we'll talk about the portfolio implications of all of these different themes. But before we get started into the inflation, whether it's persistent or transitory, we want to revisit one of our major secular themes here at Beacon Pointe, the idea of financial repression. And as we bring Michael into the conversation here, Michael put a paper together mid to late last summer that was posted on our website at beaconpointe.com. That you can go check out. And it really talked all about the idea of financial repression. So Michael, do you want to just share an update on the secular theme and how that relates to our investor portfolios today?
Yes. It informs all of our decisions. And thanks very much, Kevin, for the intro. And thanks everyone for joining this edition of the Macro Markets webinar. We wrote a paper out of the research team here in Beacon Pointe last summer. It was called Investing in the Age of Financial Repression. I'll give a brief recap because it is the overarching theme. It does inform our longer-term investment decision-making process, and I think it's going to be here for a while. It's played out quite well. First, I'll define it. If anyone is wondering what financial repression is, it's really official policies that lower interest rates and hence the government's cost of borrowing. And it's important in the current environment because of the debt load that we achieved in the aftermath of the COVID recession. We increased debt in the aftermath of the global financial crisis as we used deficit spending to try to combat the recession. We did the same thing in March, April, May, and June of 2020 during the Great Lockdown. It's important that we do that. It's important we bring fiscal policy to bear, but the aftermath, of course, is very high debt levels. So you've got to manage the interest rates, and you've got to manage a little bit of a higher inflationary environment to make sure that the national debt as a percent of GDP comes down. Just to put it in perspective, here's a look at the national debt in the United States as a percent of GDP going back to World War II. We're at the highest level since World War II. We're at about 124% right now, debt to GDP. It is the highest levels we've seen, but we have an outlook that's a little more sanguine going forward. The major implications of the increasing debt now are potentially behind us, and with the faster economic recovery we've seen, the numerator in that equation, the denominator, that is GDP growth, is rising, and that makes the debt outlook a little better. Having said that, financial repression has played out exactly as we'd anticipated it about 16 or 17 months ago, and we're not out of the woods, nor will we be until debt to GDP gets somewhere in the below 100% range. So it's important to reduce debt because it exposes the economy to exogenous shocks. And frankly, if it crowds out private investment, it reduces GDP growth. So financial repression are the policies that help you to reduce GDP. And frankly, it's the only way to do it without either raising taxes or trying to balance the budget. Neither one of those is terribly popular. in political circles. So financial repression it is, and it will inform how we feel about the world for the time being, at least for the next 2 to 3 years. Let me tell you what the hallmark of financial repression is, and you've heard me, if you've been on these calls before, talking about negative real interest rates. Negative real interest rates are literally the best evidence that you have that the policymakers in Washington, who have control over both the level of interest rates via quantitative easing at the Federal Reserve and inflation, given the inflation framework that the Fed's following. So they have control over both of those things. If they let inflation run a little bit hot, you subtract inflation from the observable nominal interest rates in the market, and you get the real interest rate. It's basically what you really get on an inflation adjusted basis. They're rare. Negative real interest rates are rare, but not unprecedented. And frankly, real interest rates today at minus 110 basis points are the lowest they've ever been since Treasury inflation protected securities were invented back in January of 97. So keep in mind this negative real interest rate environment, because it informs how we allocate assets in client portfolios. I've been asked a lot about what the limit of quantitative easing and frankly the debt issuance that caused the increase in the national debt. And the answer to that question is fairly straightforward. The US dollar is and will remain the reserve currency of the world. There is no immediate threat. On the left-hand chart here, you're looking at the currency composition of global foreign exchange reserves. That is, what is the currency that most central banks outside the United States hold on their balance sheets in order to stabilize their economy and manage their currency? The answer is the US dollar. The US dollar dominates. It's almost 60%. It's averaged more like 65%. So it's coming down a little bit as the euro, as the Japanese yen and the Great Britain pound steal a little bit of market share, but really it's immaterial. The one that everyone asks about is the renminbi, the Chinese currency. You can see here it's actually a very, very small part of global foreign exchange reserves. It has increased dramatically in the last 4 or 5 years since the IMF has been tracking the renminbi, but it went from 1% to 2.5%. So it's really immaterial. They're not going to take reserve currency status. None of the currencies listed here are threatening the US dollar, and that is the key point when asked really how much, what's the limit to our ability to issue debt and our ability to print money. The answer is the maintenance of reserve currency status. It's why we need to move back from these emergency quantitative easing and money printing policies, and why we need to pursue policies of financial repression. You need to get the debt load down, and you need to at some point stop printing money, or you will lose reserve currency status. But that's the answer to the question. What are the degrees of freedom that we have in the United States? And the answer is they're extensive. Quick update on global growth. Going to answer the question why the global economy is like a ketchup bottle. That's a reference to bottlenecks, et cetera. Knowing where global growth is headed is important. It's the backdrop for risk taking, and we'll talk about where things stand right now. We did have a bit of a COVID, a Delta variant dip in global economic activity. This is the JP Morgan Manufacturing and Services Purchasing Managers Indices. Services, of course, crashed in the aftermath of the COVID lockdown, but they've recovered nicely. Manufacturing of goods is also well above the expansion line, which is the 50 here. So we're at 54.3 and 55.6. Those are the global numbers. The breakdown for the PMIs here across various countries, from left to right, you can see red, of course, is bad, low, very low activity. That would be March, April, and May. China came out of it pretty quickly back then. You can see we had a peak in April, May, and June across the globe, and then the lull. This is the COVID Delta variant slowdown, but things are getting back on track. We're moving from yellow to green. Global activity is picking up. Services activity is still positive, and frankly, it appears to be accelerating now. So this is a good backdrop, a relatively good backdrop, should it persist, for risk taking. One of the things we've been following all along, and it's been a tremendous tailwind to asset prices and, frankly, the global economic recovery, has been monetary policy. Not just here in the United States, but globally, central banks have been spraying the globe with liquidity. And this has allowed the economy to recover in a fairly swift fashion. I'll just highlight that back in 1920, that was the year of the rate cut. where you had 91 rate cuts and only 10 rate hikes. This was in the whole full year of 2020. Here we are through, this is actually through November now. We have more rate hikes than rate cuts. And in the emerging markets, the average emerging market policy rate or central bank rate is actually up about 1.4%. Whereas, and again, this is a different scale. Emerging markets went from 2.5% to almost 4% as an average central bank policy rate. Whereas in developed markets, they barely budge, but they're on their way up. The scale is completely different here. You're going from 1 basis point to 5. So hardly a cause for concern yet, but the trajectory, this could easily extend out. So the point is, one of the things that has helped in the recovery, both economically and frankly has caused asset prices to go up dramatically, is the fact that we've had very accommodative global monetary policy, and that seems to be reversing. The next topic, and Kevin previewed it, is section 1 of our chat. It's the inflation question, whether it's persistent or transitory. And one of the things I'll highlight is that we're at this trifecta of rising prices. We've got higher goods prices, higher wages, and higher rents, which are a function of asset price and housing price increases. The higher housing prices go, the higher rents go, and that is a direct function of Fed quantitative easing. Of course, the Fed did announce that they're going to be tapering quantitative easing or an asset purchases and finish up QE by next June. So again, it's an area to keep an eye on. It has been this tremendous aid in recovery and in asset price appreciation and house price appreciation. So it's something that we're highly focused on when trying to see just how the Fed is going to navigate. But the inflation question is entirely tied up with Fed policy. If the Fed believes that inflation is persistent, then they're going to have to act to raise interest rates. But I just want to highlight that you've got this interaction and a trifecta. They're all rising at once: goods, wages, and rents. And you need to break the cycle here. One of these three has got to, or two of the three would be best if they started to show some signs of easing. And you do, and this is the analogy, of course, is a ketchup bottle that's clogged at the end, and things are starting to potentially, there's some light at the end of the tunnel in terms of supply chains, and that will help dramatically in reducing goods prices. We're not seeing much movement. And by the way, I tilt the ketchup bottle to effectively suggest that there's a little bit of movement. We may see some loosening of the backups in the ports and in the trucking lines that is in our transportation infrastructure here in the United States. There's a little bit of movement. There's light at the end of the tunnel. We haven't seen it in the data yet. Hopefully it appears before Christmas, probably not into a material degree. As for wages, wages are going up. They're going up pretty big, but that has not translated into bringing people back into the labor force. So goods prices, wages, and rents are going to continue to move up. They're persistent, and they have a tendency to get some momentum behind them. But we need to remove the bottlenecks. We need to remove the labor force dislocation bottleneck and the infrastructure bottleneck to get one of these two, either supply chain back on track to reduce goods prices, and the labor force to come back in, go back to work at the higher wages that are being offered now, which will eventually cause wage price inflation to decline. That's the big issue. Let me dig in a little bit, because there's another way to look at inflation. And you can try and make some judgments about whether inflation is persistent or transitory by labeling the inflation impulse as either cost push or demand pull. These are common macroeconomic terms. Cost push occurs when you have input prices, whether it's raw materials or labor, that's costs of production, pushing prices higher. Whereas demand pull is when the consumer has the ability, willingness, and wherewithal to actually increase overall aggregate demand, and it's the higher demand which is not being met by increases in supply for whatever reason that causes demand pull inflation. So getting a handle on whether the drivers of the current inflationary impulse are cost push or demand pull might actually give us a clue as to whether or not things are transitory or persistent. Cost push type of things, which I've indicated in the blue, the light blue circle, would include on the left-hand side a positive cost push, that is input prices going down, would be one of the 3 Ds: technological disruption. The other three Ds, or the other two Ds, are debt and demographics. Aging demographics is a negative, and it's part of the demand pull equation. Debt overhang also reduces demand. That's part of demand pull. So those are the three Ds. These are the long-term drivers of inflation, and they're on the left-hand side. But what's outweighing them now, of course, is the massive amount of money printing that we've seen in quantitative easing, and the fact that the Fed's going to let it happen via their new policy framework, which is average inflation targeting. And then there's a litany of potentially transitory cost push influences on inflation right now. The biggest and the most popular in the press is the supply chain disruption, in addition to labor market dislocation. But deglobalization is key. Imports from China and the tigers in Southeast Asia have been a tremendous disinflationary force in the economy for quite some time. And that is reversing now. And as it reverses, it will cause inflation to bubble up here in the United States. That's a cost push type of inflation environment. And frankly, aggregate demand, that's the definition of a decrease in the output gap, or a decrease in slack in the economy, is an increase in aggregate demand, which is by definition demand pull. So you've got this tug of war, or this teeter-totter, which is now tilted in favor of higher inflation going forward, because some of the long-term and some of the short-term forces of inflation on the right-hand side have now dominated the longer-term forces of disinflation that reigned from 2008 until May of this year. Where do we stand? Well, we did get an inflation print yesterday. The CPI is here. The headline number is 6.2. It's the highest number since November of 1990, highest in 30 years, and up from September, which was 5.4%. The core number, which excludes the more volatile food and energy — I don't know why you exclude food and energy. Everybody needs food and energy, gas prices in particular. Gas prices actually contributed pretty meaningfully to the difference between the core CPI number and the headline number. They're included in headline. But these numbers are kind of off the charts. This is only 8 years of data, but if you went back 20 more, you'd see that 6.2 on the headline CPI is the highest since the early 90s. And frankly, it's a little bit about not just the overall numbers, because these have some outliers in them, but these inflation gauges, these indices here, which are the Cleveland Fed trimmed mean and the sticky core CPI from Atlanta Fed, the Federal Reserve looks at these other modified inflation gauges to determine the persistence of the current impulse. And by trimming out the outliers, you can get a better sense of the stickiness of inflation. And unfortunately, these were pretty well behaved until the last two prints. And right now, the Cleveland trim mean is way in the danger zone up here in the red, whereas I would call the Atlanta core sticky CPI, which is again another more persistent type of inflation gauge, looking in the yellow zone here. So the Fed's going to continue to say it's transitory, and that we should effectively ignore it. And so far, the bond market is doing so. But these numbers certainly give one pause when trying to determine whether it's persistent or transitory. Another good way to look at it is to see where the increases in prices are coming from in terms of the components of CPI. This is the October print from yesterday. The possibly transitory elements, and these are typically some of these are pretty small in terms of their relative weightings in the CPI. Some are big. Energy is pretty big in the CPI, and frankly, owner's equivalent rent is also very large. But gas prices really have spiked in the last year, and they continue to rise. They're up 50% from a year ago. So here's your headline CPI 6.2 number, and these are just CPI components. So we can see, and we can split up these components between possibly transitory and things that the Fed would care more about in terms of the persistence. When you see wages and rents increase, by the way, and here's the Fed's 2% target, it's the red line. But when you see wages and rents well above the Fed's 2% target, then you know it's going to get the attention of the Federal Reserve Board. But the question is, how can you consider? Well, you can continue to call it transitory, but you got to define transitory. And where the Fed would have initially, I think, in the second quarter and the beginning of the third quarter, attempted to define transitory as 4 quarters. That is, sometime in 2022, we'd see some relief. I'm a little skeptical. I think when we talked about the ketchup bottle analogy, when the bottlenecks are opened up, then both the supply of labor and goods are likely to increase dramatically. And when they do, that will be disinflationary. but it's not likely that the labor market dislocations, which I'll talk a little bit more about in a sec, are going to be relieved anytime soon. And frankly, while we're seeing light at the end of the tunnel in the supply chain, to reorder global supply chains that are 30 years in the making is going to take some time too. So it occurs to me that the definition of transitory is probably something more like 8 quarters than 4 quarters, which puts us more like in 2023, in the second half of 2023, which is going to be okay. If the Fed can properly communicate, then we won't see any disruptions in interest rate markets. The Fed is going to have to start acting to maintain their credibility, which is a straightforward deal. That is, they're going to start raising the Fed funds rate probably as soon as could be as soon as June or September, probably September of next year. We'll see. But this is a key chart when I think the Fed is looking at this and trying to make that determination about whether they need to act now or whether they can kind of wait and see. And they've chosen to wait and see. Their communication has been excellent, by the way. They've done an excellent job. The FOMC meeting here in November, where they actually announced tapering, was a masterclass in central bank communication, and it has allowed the equity market to continue to rise because, frankly, higher interest rates are not good for equity markets. We'll see that in a second. In fact, it's not too strong a point to suggest that interest rates here in the United States are likely to be as impactful for bondholders as they are for equity holders. As interest rates rise, of course, bond returns go negative. As interest rates rise, the discounted cash flows associated with equities also have a tendency to be re-rated lower. So higher interest rates generally mean, especially unexpected higher interest rates, will mean a more challenging environment for equities. So if inflation is transitory or persistent, probably the most important thing we can get right in terms of our investment outlook. And one of the things that the Fed is always focused on is market measures of inflation expectation. So these are effectively the long-term. This is the long-term inflation expectation that's embedded, frankly, in forward interest rates. Okay, it's called the Fed 5-year forward break-even rate, and it's a measure of average inflation over the next 5-year period that begins starting in year 5. So it's basically a measure of inflation from 2006 to 2031. So that's what that means. This is the outlook for the next 5 years. So you're looking at 10 years worth of inflation expectations. Here's the first half, here's the second half. Point is, the Fed's focused on this one. Fed credibility is measured by the level of Fed 5-year forward break-even inflation. If this number starts to bump up against 2.5, the Fed is going to have to start talking tough, get a little more hawkish. We'll talk about the composition of the FOMC and the Fed's rate setting board when we get to the DC section. But right now, short-term inflation expectations are in the danger zone. Longer-term inflation, I would call it in the caution zone, right on the cusp. 2 3/8 is kind of where I see, plus or minus. We're under 2 3/8, probably okay. You get above 2 3/8 and you're headed to 2.5% on this particular measure, the Fed's going to start talking about it. Just to put this 3% into context, the 20-year average, the 10-year average of this number is closer to 1 3/4, and we're above 3% now. So we're in very elevated territory here. Fed's got to maintain inflation expectations. If they become unanchored, their job becomes almost impossible. Just a quick summary of what's going on off the coast of California and in other places. This is the supply chain. This is just a picture on the left here outside the Port of Los Angeles, Port of Long Beach. This is frankly a container ship that's got a bunch of what we call 20-foot equivalent shipping containers on it. So if you see bottlenecks being measured in terms of the TEUs, or 20-foot equivalent units, that's one of those right there. And we're still in the catch-up bottleneck right now. Here's a chart. It's 8 times the historical level of ship capacity that's stalled in ports. So this number, these boats, there's usually an eighth of them that are out there. So you've got 1.6 million of these shipping containers stalled in ports, waiting to be either unloaded or returned to the country of manufacture, 8 times the historical level. And it all started back in January of 2020. So there's a lot of shipping containers that are sitting out there. And in traffic delays, traffics are delayed by 3 times the average in terms of in hours, median monthly hours. And ship reliability, this is an easy one to get a hold of. Less than 35%. Most ships, 75% of the time, ships are arriving on time, but now only 35%. These are all numbers from a subscription service called Sea Intelligence. and from the World Bank. And frankly, it doesn't present a very good picture. I did mention there was light at the end of the tunnel. And the light is that some manufacturers are seeing what the government's doing in terms of getting Port of Los Angeles on a 24-hour day in terms of unloading. There's light at the end of the tunnel in terms of semiconductors, nothing happening yet. Again, these are all predictions. Now, people are forecasting better days in coming quarters because they're seeing certain things and certain entities that can influence this responding. So there's a little light at the end of the tunnel in supply chain, but it's still going to take a while to work it all out. I'm just going to focus, I think everybody knows, this is the labor market bottleneck we talked about, and the fact that there's 3 or 5 million people that have basically retired since COVID and aren't coming back into the workforce. So labor force participation is way down, and that makes job openings really hard to fill. And when businesses, this is the blue line here, that's at record levels. Record levels, when you ask a business owner, is it easy or hard to fill a job? Half of them are saying it's really hard. And wages always follow, and they've spiked. Wages have increased dramatically. The point I want to make on this chart is, frankly, wages can increase as long as workers are more productive. That is, you can pay somebody more if they produce more output. That is, it doesn't affect margins. You're producing more output, so revenues are higher. You can afford to pay somebody more. So what you really want to focus on is productivity adjusted wage inflation. And it's a pretty volatile number. Productivity numbers are volatile, but I just want to show the last 10 years. The last 10-year average wages have increased by call it 1 3/8% over and above productivity. But now wages are increasing faster. There's been this spike in wages. So wages adjusted for productivity are much higher than they have been over the last 10 years in the last 8 months. And this is a number to keep an eye on. The number is productivity adjusted wage increases. If this goes up higher, then you will see a more persistent and difficult situation. The Fed is clearly focused on productivity adjusted wages. We look at wages because it's easier, but what we really want to look at is productivity adjusted wages. And it highlights this persistency question. If productivity comes back and starts to rise again, it will push this wage inflation number down, and that will alleviate some of the Fed's concerns. 1 or 2 more slides on inflation, then we'll open it up to questions. There's a few coming in, and I imagine Kevin's got some of his own. I did mention quantitative easing. I'll just highlight here. This is the Fed's balance sheet. This is the quantitative easing effect. This goes back 15 years now. We're at 8.5 trillion on the Fed's balance sheet. Nominal or M2, which is a multiple of the Fed's balance sheet, which is effectively the monetary base. M2 is the number that's in circulation. It's the one in all the quantity theory of money equations. And this is nominal GDP. So I'll just highlight a couple of trends. Here's the trend in M2. And M2 is well above the 15-year trend line. Here's the trend in GDP. GDP is above, but not on the order of magnitude that, and these, by the way, all same scale, order of magnitude above GDP. This could be a problem. GDP is above trend, but money supply growth is well above trend. And it's going to, this is why the Fed's going to need to start to taper, which they announced again a week ago. So they are going to taper. This is why if money supply growth on its own is not a problem, it's money supply growth versus economic activity. And you can see one is well above trend while GDP growth is not. So that's why the Fed's tapering. It doesn't mean you're going to get hyperinflation by any means. That's a phrase that has hit the Google search pretty hard and has a lot of hits, but there's no such, it's not going to happen. This is not a hyperinflationary environment. It's not necessary to seek out hyperinflation hedges just because of this, because this number is going to go down while at the same time GDP continues to go up. Last inflation slide, rent is up 9% year on year. This is a persistent function. This is from Zillow's rent index. 3-month moving average of rents are up now, so it's got some momentum to it. They were over like 1% back a year ago, but now the 3-month moving average of rents is closer to 9%, while house prices have spiked as mortgage rates have come down. So house prices up, that's not very transitory. Rents, because house prices translate into rents, right? I mean, you got to get a higher rent if your house costs more to make it if you're a rental property owner, So as residential properties increase, rents increase. So these things are fellow travelers. That's how, unfortunately, you get prices embedded into the economy. It's the prior slide when wages increase faster than productivity and rents that increase because of house price increases. So last slide on is the commodity slide. I'm just going to point out oil's ripping higher based on the economic reflation argument, and copper is also increasing. The green line here is global economic activity. So copper's been choppy for the last 6 or 9 months or so, whereas oil has continuously shown an increase. If I had to think about some of the things that were contributing to this, the uncertain inflation environment, wages, we got some handle on that, goods prices, it's energy prices that are really kind of a wild card here because OPEC is now enjoying pretty substantial profits from the price of oil. But eventually the high price of oil, not like the 70s. We're not in a 70s stagflation environment, by the way, with this high oil price. This is nothing like the 70s. But higher oil prices will eventually cause they've already caused gas prices to increase dramatically. We saw that on a prior slide. It's eventually going to slow down economic activity because consumers won't be able to have, it'll reduce their discretionary income. So that's the inflation story, and I'll toss it back to Kevin to see if we have any questions.
Yep. So I've been monitoring the questions that have come in, and as you would expect, a lot of questions around the impact of this on investor portfolios. So that is the last section of the conversation today. So just in the interest of time, I think it's great to just table those questions. We will get to those as it relates to the last section, but it sounds a lot like, Michael, the jury's still out on whether the inflation is transitory or persistent. The Fed's been saying transitory. A lot of the information that you've shared today said that the jury's still out, wouldn't you say?
Totally. Anybody that's making a firm bet on transitory or persistent, there's a lot of unknowns, and most of them relate to, frankly, the three buckets that I talked about. So labor markets, which cause wages to increase. If you will get an equilibrium once wages increase and labor comes back, and then all of a sudden there's no ability for workers to command higher wages. So that's one area. Capital or goods inflation is a function of supply chain, which as I mentioned, there's some green shoots or light at the end of the tunnel, but that's really hard to get right given how the type of infrastructure that's been put into place for just-in-time inventory adjustments, et cetera. And finally, there's the housing market. So we don't really want house prices to crash, but if they started to cool off a bit, then you would see some adjustment in rents. But that's the embedded one. That wages and rents are the ones that are going to be more persistent. If we can get goods prices to come down, that'll have a dampening effect, and inflation will moderate. And I feel like, given the interaction between all of those three, it's probably 4 to 6 more quarters instead of the 2 to 3 I think the Fed originally estimated.
Great. Yeah, let's move on. Just in the interest of time, let's cover, because a lot of the questions that are coming in, I think you're going to address in the next couple of sections.
Yeah, and I just put a preview to the question, what are in portfolios? Tips in real assets and real estate are the answer to that question. And we've recommended substantial, up to at least 10 or 12% of the portfolio be in those assets, going all the way back to last August and September. So let's talk about equity markets. Everybody wants to know about equities. I think there's a lot of near-term positives in the equity market. I think the most powerful thing we've seen in 2021, it hasn't been, the level of the equity market hasn't risen because of expansion in multiples. It's because earnings have rebounded so dramatically. And I'll just highlight quickly on this chart. The second quarter year-on-year EPS growth was at 88%. 88%. That's that's an all-time record. 38% is the actual so far, with 490 companies out of 500 reporting. So feel pretty confident. 38% EPS growth in the third quarter. The reason that's a positive is because they were only forecasting, analysts were forecasting 27% EPS growth, and we got 38. So EPS growth surprises continue to propel the equity market higher. Solid earnings, pretty big positive in the near term, as is seasonality. Again, light at the end of the tunnel in the supply chain issues, not realized yet, but predicted. Looks like taxes aren't going to go up on corporations as much as originally thought, with the U.S.-centric corporate tax rate hike from 20 to 25 is what everyone was talking about. But with the global minimum tax at 15%, that's going to relieve, I think, many corporations from effectively having to see a diminution in net income because of higher taxes here in the U.S. And the central bank, again, keeps talking about policy being accommodative, and they're pushing back on rate hike fears. They're going to have to hike rates eventually, but at least the communication is positive for equities. And frankly, some third of companies out there, it used to be zero, are reporting that they have increasing pricing power. Good for corporations, bad for consumers. So those are the near-term market positives. Quick recap. This is a return on the S&P 500 since the great financial crisis low, and it's up 600%. There's only been these two hiccups. That was fourth quarter of 2018 and the first quarter of 2020. Since the COVID crisis, since the March of 2020, we haven't had more than a 5% downturn in the S&P 500. We had a little 7%er back last summer, a 9.5%er last September, a 5% this September. But since the first of the year, we had until September, second week of September, we only had 3 or 4% downturns. And since that downturn in September, and because of the FOMC, the dovish remarks from the Fed and good earnings news and the S&P has powered higher by 8% since just the beginning of October. Very few hiccups. Why? Because of the Federal Reserve. This is a picture of the Federal Reserve on K Street in DC. The Fed has been on it since 2009, and since QE began in 2010, we've had 4 QEs. We've had QE infinity now. So the QE's going away. Tapering is happening. So it's a big question mark going forward. I just want to highlight the fact that one of the big headwinds to equity markets is going away, which could cause interest rates to move up. And if interest rates move up, then a lot of bets are off. If they move up unexpectedly and if they move up quickly, they're going to go up. But whether or not it happens in a gradual way or quickly makes a lot of difference. I'm just going to highlight that here's the S&P trades at almost 22 times at the level of the close yesterday, 46.47. So a couple of different projections for where the S&P could go based on expansion of multiples, which again, given the reduction in monetary policy accommodation, it's more likely the multiple will contract. So to get to 10 times in 212 earnings, to get a 10% increase in the S&P from here, we have to have a multiple expansion of two turns from 22 to 24. But I would say, and I'm not predicting the equity market crashing, but to me, the probabilities dictate more likely you get some compression in the multiple, where you would see, here's flat, 46.64 is flat. This is down a couple percent. This is down about 7 or 8%, and this is down 13% if we saw a re-rating of equity risk and you saw the multiple decline to 19 times from 22. What is the valuation metric that we look at, which is the equity risk premium, which is basically the earnings yield, say? Well, if you look at the earnings yield and then deflate it by 10-year treasuries, which is a pretty good way of highlighting times maybe to buy and sell, just to put a fine point on it. The low in the equity markets was March 23rd, 2020, and the equity risk premium deflated by the 10-year treasury yield, the earnings yield deflated by 10-year treasuries, was at 6.2%. So you're getting paid a lot to own equities back then. The 10-year average of the earnings yield deflated by 10-year is 3.2%. The 10-year average is 3.4. We're at 3.2, so it's a little bit under, not meaningfully. Equity looks okay. Equities look okay with interest rates very low, but just to put a fine point on it, if interest rates go up, this number goes down because it's 10-year, it's the risk premium, it's the earnings yield minus 10-year yields. If something you're subtracting goes higher, then what you're seeing goes lower. So, I just want to highlight that it's really dependent, both multiple expansion and the equity risk premium in this metric, in this configuration, are highly dependent on monetary policy. So it'll be important to note, where we think 10-year treasuries are going. I'll come to that in a sec. Stock market's not a one-way. I've presented this chart a lot. It goes back to 1980. The the annual return. So 1980 equities returned 33%. We're at 26% year to date now. But in every year, we've had a bit of a hiccup, on average a 10 or a 15% downdraft. But again, in 2021, we've only had a 5% downdraft. So it's not a one-way ride. Large drawdowns should be expected. Most years, though, end up positive. We just haven't had that. Kevin, anything about equities or follow-ups on inflation that we can address?
Nothing in particular about the equity markets. Again, still a lot of questions about the outlook for all of this information as it relates to our current portfolio thinking. So I think it's important to move on. You addressed the issue of valuations, which I know is on a lot of folks' minds. So let's talk a little bit about what's going on in DC and then get to the real crescendo and what that means for our portfolios.
That sounds good. I could spend 45 minutes talking about what's going on in DC. But I'll give you the highlights and a couple of comments, and that will probably spark a few questions. But the big issues are infrastructure. Are we going to get a Build Back Better bill? What does that mean for taxes? December 3rd looms large. Got the debt ceiling, which really won't be a problem, even if it was officially December 3rd. You've got Treasury's got enough cash to get through the end of December and into January, but December 3rd is the date that they picked to talk about it. The government will shut down on December 3rd without a continuing budget, without a budget, and the budget resolutions are not being discussed because there's too much oxygen in DC being sucked up by Build Back Better and taxes. And then, of course, the midterm elections come in 2022. So everything that relates to the discussion of taxes and infrastructure always go back to whether or not a congressman and the 33, I think, senators who are up for election in the midterm, all 435 congressmen and a third of the senators are up for election next November. Everything they do between now and then is with an eye on getting reelected, full stop. So whether or not they support a position or they resist supporting a position is based on their calculus on whether that will improve or diminish their chances of reelection. Why is it taking so long for things to happen in DC? Well, this is a self-fulfilling or a kind of it's a circular issue here, which is Biden's approval rating. Right now it's at 43%, whereas 51% disapprove, and that reduces substantially his legislative clout. And by reducing his legislative clout, he's getting knocked for policy gridlock. So his approval rating is more of a self-fulfilling prophecy. But the COVID flare-up and higher inflation, and frankly the Afghanistan thing in August, which it was probably blown out of proportion as it relates to the current administration, but it all accrued to diminish the approval rating of the current president. So that's a problem. In fact, he's about as unpopular as you might expect anybody. He's more unpopular or less popular than Nixon was, frankly, at the same time in his administration. But Nixon didn't become terribly unpopular till the end. But he is more popular than Gerald Ford, if that's of interest. Why has the House or the Senate been unable to move legislation? The answer is because there are 3 parties in the House and there are 3 parties in the Senate. The 3 parties in the House are the Democrats in the Congressional Progressive Caucus. There's 100 folks in the caucus, and then there's centrists and other Dems, which make up the other 119. So there's 219 Democrats and 212 Republicans in the House. But frankly, the Dems are 2 parties, centrist and progressive, and they're all tugging at Joe Biden to try to get him to move the legislation, the Build Back Better legislation in their favor. And frankly, it's causing gridlock, whereas the Republicans remain a unified bloc. And in the Senate, you have the same problem. You've got 48 Democrats and then 2 Democrats from red states and 50 Republicans. So no one has a majority. You've got 3 parties in the Senate, 3 parties in the House. So that's the reason why things are gridlocked, if it wasn't terribly obvious before. I'm just going to point out that one of the bigger decisions is who's going to be the Fed chair and how hawkish or dovish will the FOMC be next year. I'll give you my conclusions and we can circle back on some of these, but the betting markets favor Powell over Brainerd. Brainerd will probably get vice chair for supervision, that's banking regulation and supervision. So Powell will likely lead the Fed again, and the betting markets say that's the most likely outcome. In terms of the composition of the FOMC in 2022, it's going to tilt hawkish in terms of the presidents that are rotating. Right, not all the regional bank presidents vote every year. You get 4 seats and they rotate, and a couple of new voters in 2022 are coming on are these folks, and then not voting. You've got +2 that are no longer voting. So it does look like it's tilting to a little more hawkish in 2022. Again, just to highlight, December 3rd is a big date, but I wouldn't worry that much about it. There's absolutely no way that the U.S. government is going to default on its debt. The government may shut down on December 3rd without a continuing resolution. It's being used, quite frankly, as a legislative negotiating tool, which I think is a little dangerous, but I don't think that's going to be a problem. Let's get to taxes because everybody wants to talk about taxes. This chart has changed dramatically in the last week and a half. It used to include increases in personal income taxes and increases in capital gains. But now, this is our best guess now. No change, subject to change. No change, subject to change. I think I have about 3 disclaimers on this chart because it is a complete moving target. Tax policy is a complete moving target in DC right now. So just to put, this is going to be in the materials. I'll leave it here, but just know this. It's this global minimum tax rate of that's been proposed at 15%. There isn't one currently. That's going to keep the corporate income tax from going from 21 to 28 to leave it at 21. That's our best guess right now. Personal income surtax, if you make 10 million or 25 million, you're going to get surtaxed. If not, then it doesn't look like personal income tax rates or cap gains tax rates are going to go up. That's good news. Fingers crossed. Again, total moving target and subject to change. And the last slide in the DC section is simply this. These are gains and losses going back to 1902 in the Congress compared to who the president is. That is, it's the party's president, the president's party's gains or losses, mostly losses, by the way. If you're a Republican president or a Democratic president, doesn't matter. You have a tendency to lose on average 31 or 33 total members of your party in Congress every single midterm election, off-cycle midterm. Here's every single midterm. The president is indicated here, whether it was a Republican or a Democrat. And here's the changes. The net changes going back to 1902, average 31 losses. I'll highlight, by the way, only gains in 1902, 34, 98, 2002. And look at 2018. 2018, a complete outlier. President Trump gained 46, I think, members. No, 45, 2 senators and 43, 2 senators and 41 House members for a total of 43 additional Republicans back in 2018. Hugely unusual. The volatility is increasing, it appears, which is another likely sign of polarization. But it's not, doesn't look good if you're a Democratic senator up for re-election or a Democrat in the House. You're always up for re-election every 2 years. Doesn't look good for your chances. Portfolio implications, Kevin?
Yep. Well, one quick question that came in. So, and it relates to a lot of the stuff that you've talked about already, which is fiscal versus monetary policy. Which one do you think is going to be more impactful over the near to intermediate term?
Neither. So monetary policy is almost always the most impactful, but you're going to see the mother of all fiscal reductions, fiscal impulse reduction. So fiscal tightening, you're going to get both fiscal and monetary tightening going forward. So while you have the double barrel tailwind for the economy and for markets of very expansive, unprecedented expansive fiscal policy and unprecedented monetary policy, both of those are reversing. So if the question is, how do you rate those relatively? I almost always put monetary policy in the lead. It has driven everything. If you didn't know anything else in the last 15 years, tell me what the Federal Reserve is going to do at their next meeting, and I'll tell you how to position portfolios. It's how impactful it's been. That will not change. Monetary policy will be gradually reduced, whereas fiscal policy is going to drop off like a cliff. And that's because the new bills have spending on the order of, call it $2.5 trillion of additional, maybe $3 trillion of additional spending included in the infrastructure bill and in Build Back Better, but it's going to take 10 years to realize it. So you take all that spending divided by 10, and that's the impact for 2022. So it's monetary policy that remains in the driver's seat.
Great. So as we get into the portfolio implications section, clearly a lot of the questions center around with the inflationary pressures that you've already addressed. How does that impact the bond allocations in client portfolios? And I know that certainly over the course of my almost 30-year career in the investment industry, bonds have been a phenomenal counterbalance to the equity markets. And with some of the equity market risks that we've seen, truly bonds are a foundation of a well-balanced portfolio. Can you talk a little bit about that, of course, in the implications?
Yeah, we've harped on negative real yields as being a real drag on a 60-40 portfolio. But when push comes to shove, and we've seen it when interest rates decline. I mean, interest rates peaked in March, on March 31st, actually, of this year at 174 on 10s, and then they promptly rallied 60 bips down to 117 on 10-year treasuries. If you didn't own any bonds in that scenario, you would not have realized a fairly substantial cushion to what else was going on in the world. And frankly, you would have had a nice positive return on bonds. So bond prices go up and down, and obviously they do so inversely to yields. If we think interest rates are going up and bonds only yield, 1.5% right now, why are they in the portfolio? And the answer is because it's not about picking an individual line item in the portfolio and saying it's going to outperform or underperform something. That's not the essence of thoughtful portfolio construction. Thoughtful portfolio construction includes one other key factor, which is the correlation of a bond, of asset classes, whether it be a bond with equities or alternatives or cash. And to put a fine point on it, bonds will continue to provide their historical hedging capability versus a bad outcome in equity markets. They will provide less of a cushion because interest rates are low, and as interest rates decline and as they get low and as they perhaps move up, the correlations aren't as low versus one, right? One is complete correlation. You'd like to see negative correlation, but that's not going to happen. The correlations are rising between equities and bonds. That's a problem for hedging, but it will not eliminate the need to have both liquidity in the portfolio, which is provided by bonds, and they will continue to perform their historic hedging function, just less so. But to void the portfolio of bonds would be not prudent. I can't say it. I could say it a lot stronger than that, but that would not be the way to go. You're not getting a lot of income, so look at alternatives. And what I mean by alternatives is alternatives like private credit and other things that can help replace some of the income without going too far down. You're going to have to go into less creditworthy bonds to get a positive real yield, but we're going to be through this. Financial repression is not going to last forever. So stick with the longer term asset allocation, nudge the portfolio around, reduce your fixed income somewhat, certainly not zero, and find things like private credit, private real estate that can both provide some income. And frankly, in the private real estate and private credit, some hedging properties versus higher inflation and higher interest rates. What I mean by that is private credit is generally a floating rate note, which is your yield is reset every 3 months. So if interest rates rise, they have a very, very low duration. They have very low exposure to interest rate risk. Private real estate has historically provided some inflation hedging capabilities too. So there's a fair amount of things to do even with interest rates this low. TIPS would be another one. We started recommending TIPS 14 months ago. They're still a good investment. Don't be thrown off by the seriously negative real interest rate in TIPS, because they improve the portfolio's alpha generating and frankly correlation characteristics. That is, they diversify the portfolio, but they have alpha generating characteristics if inflation expectations continue to increase. Now, at this current juncture, inflation expectations have spiked from where we first started recommending TIPS. They were about 1% 14 months ago. 1% inflation was expected. Now we're at 3%. So the easy money in TIPS has been earned, but they still have a place in a portfolio because should inflation spike further from here, they will significantly outperform nominal bonds. So there's a lot of things you can do: TIPS, private credit, and frankly, private real estate, or other options if you don't have access to private investments are available at lower minimum initial investments with less liquidity requirements.
Great. And then a number, in addition to all the bond questions, which you just did a great job of addressing, a number of questions have come in around our thoughts on the equity allocation, specifically around the international equities as it relates to emerging markets, given everything that's going on in China and the Asian equity markets.
Yeah, China's a puzzle inside a riddle, inside of a conundrum, to a certain extent. But when looking at the arc of history, it's not. China made an intentional move by turning the dial from pure socialism as a communist country to a hybrid market socialist economy in order to accelerate growth and to be able to regain China's place on the world stage, and to become a force. That is exactly what happened 40 years ago. It's played out remarkably well. But at some point, and now that China's become either the first or second largest economy in the world, depending on how you calculate it, there's a return to the dial is moving back away from business friendly to less business friendly. So emerging markets, which by the way, the EME index is like 40% China, is entirely driven by how you feel about China in some respects. So our view in China has actually become a lot less constructive in the last 3 or 4 months as the reality of common prosperity comes to the fore. And common prosperity just means that the ruling body, the Communist Party of China, which runs the country, aren't going to tolerate capitalists who've made billions. So they're cracking down on tech companies. Frankly, part of the property company issue there is directly related to the government's unwillingness to support property companies like they have in the past. So emerging markets have a place, but less of a place now than they did 3 months ago, because the uncertainty about how China's business-friendly experiment will continue in the near future.
And then a couple of questions have come in. It's always a hot topic of conversation around crypto and the impact of crypto. So I think it's probably worth addressing our thoughts there as well.
We're trying to figure it out. I would say we've got a working group here at Beacon Point that is looking at whether or not cryptocurrency in particular is an asset class that should have a formal opinion or recommendation from Beacon Point. To date, basically what I've said about crypto is, and our research team has said, we don't know how to value it. It doesn't have a fundamental value. It doesn't have a cash flow. It doesn't have any kind of a theoretical intrinsic value. So how do we value it? And the answer is a lot of new things don't, but things shake out. You start to use empirical data and maybe an idea about where this could go that tends to have a great deal of impact on whether the price goes up or down. If I don't have an ability to establish a fundamental value for any asset, it makes it really hard to say we should recommend that. Having said that, obviously crypto has done really well. I'm a bigger fan of blockchain technology because that is a game changer in many respects. So our group at Beacon Point is digging into this issue to the extent to a much greater and a much more disciplined way, I think, than a lot of folks. And the reason we've kept out of it is because there's been a lot of innovations in financial markets that played out excellently for a couple of years and then didn't. So we're just being very cautious and thoughtful about it. We're not excluding it as a possible allocation in the future, but until we can get a handle on its fundamental value, it doesn't qualify as a currency. It doesn't qualify in the definition of an asset class that I'm used to. But I'm open-minded about the possibility that this is something new that we should be putting out there for clients, just not today.
And last area is just to run down the current portfolio positionings, over and underweights that we're suggesting for portfolios, and then the overarching question is the view on when COVID becomes less of an issue for investment planning. I think it's already becoming less of an issue. At least corporations are starting to look at sort of recent history and planning for the future, whereas for the first year post-COVID, it was just a guess. Corporate earnings were a guess. So I do think from an investor's perspective, which is driven by business planning perspective, corporations are already moving into a post-COVID environment where earnings expectations aren't a complete total guess. As they reorder supply chains, as wages find an equilibrium and I think you'll see that we get back to more of a fundamental assessment of the environment. But monetary policy will continue to play a disruptive or a distortive effect for the foreseeable future. So COVID, monetary policy are the two disruptive events, I think, that have driven both the downturn in equity prices and then the substantial rebound. The answer is, I don't know. I would love to be able to say with a high degree of certainty it's somewhere in the near future. If I had to, and it's a guess, I would say sometime in 2024, we won't be talking about it nearly as much.
and that the COVID will turn into basically an annual persistent or chronic flu type of a thing. That seems to be the most likely outcome, but I really don't have any information advantage on that one.
Mm-hmm. Sounds good. So let's talk a little bit about the game plan for portfolios as we wrap up here, because I think that's the last set of questions is just, domestic versus international. Do we expect any currency movements to influence that? Stocks versus bonds, alternatives and how they factor, which you've already addressed some of those, but do you have any specific things you want to finish up with?
Well, I think so. I mean, some of the things that we've been looking at, we put this out there a year ago now, and I've added the stoplights because we're a little less sanguine on credit markets right now, at least public credit markets, because spreads have tightened to historically very low levels. So where we were incredibly enthusiastic and frankly had a pretty meaningful position in credit in our portfolio recommendations immediately after the COVID lockdown. That is, we literally wrote a memo on March 24th that said we need a bunch of high yield in the portfolio and we recommend between 3 and 6%. That we're a little more cautious on credit, whether it be high yield or high yield corporate or high yield munis. Equities still feel okay, especially in a world of negative real interest rates. Doesn't mean you should void the portfolio. Fixed income, we talked about that, but equities look a little better than bonds given the outlook. Now, we're starting to get into some rarefied air in terms of where the equity risk premium is if inflation or interest rates rise. So equities, we would expect within equities, while generally positive, there's probably some more opportunities in value and small cap and maybe non-US versus large cap growth, which has enjoyed a pretty massive recovery in the immediate post-COVID world. Inflation protection remains top idea. I mean, these types of trades have done really well. Commodities in terms of natural resources, less precious metals now. Precious metals, particularly gold, has not performed as its traditional inflation hedging function as it did in the past, partly, I think, because of Bitcoin, perhaps. There's been something that's disrupted the thesis that gold is a good inflation hedge. It may reassert itself, but we're not going to be there for that because it just doesn't, I'm too uncertain. We're too uncertain about it in our research department. Last but not least, international equities. They've underperformed massively in the last 10 years, but they outperformed massively in the 10 years prior to that. And non-US dollar assets are a dollar story, whereas 3 or 6 months ago, I was much more likely to feel that outside the US interest rates were going to rise and the interest rate differential would cause the US dollar to depreciate. Now that the US is moving towards, and maybe the first country, different than what we thought maybe a year ago, to come out of the monetary policy accommodation. That is, as the US raises interest rates, the US dollar becomes more attractive. So while we would have had a strong view of the US dollar depreciating a year ago, it's somewhat less. I could probably copy and paste this caution now and sometime in the coming months, put it over here. That's not a done deal yet, so I didn't highlight it today, but just know that there's a better way. With negative real interest rates, which are a total hallmark of this financial repression environment that we're in, there are things that you can do, and they relate primarily to moving away from traditional asset classes. And within the traditional asset classes, a little bit of underweight to fixed income, a little bit of overweight to things like large cap value and small caps will probably serve the investor very well in coming quarters.
Great, thank you, Michael. And just to wrap up, you can find additional information from us here at Beacon Point with our monthly piece, the Beacon Point of View. That's also posted on our website, again, beaconpoint with an e.com. We also have podcasts. So if you choose to consume information via podcasts, we have a Dollars and Cents podcast hosted by 2 of our wealth advisors. And then we also have a Markets in Motion podcast that Michael puts together on a timely basis whenever there are things going on in the market that warrant quick updates in between the quarterly macro and markets calls. So again, Michael, as always, chock full of information, a lot of great material here for our clients to consume. And it's great to know that we have such a seasoned and expert investment team and team of institutional quality asset management partners that are working with us and our clients here at Beacon Point. So with that, we'll say thank you very much for joining us today and have a great rest of the week.